You're not here to learn about legal entity setups. You're here to learn about how to save taxes. Welcome back and welcome in everyone to the exciting world of entity structuring. So if you've ever had a question such as, should I put my property into an LLC? What kind of entity should I be? What is an S Corp? And do I need my real estate in there? What about my wholesaling, my flipping, my property management? What kind of entity do I need for it? Can it all be held in the same business entity? Can it be held in the same one as my rentals? Can I hold all my rentals in the one LLC? Do I need to separate them? Should my spouse and I own it 50-50? Exciting stuff, right? So let's unpack it. Part one, guys, let's break down legal versus tax entity structures. Every business has two entity types. Start thinking of it like that. There's a legal entity type and a tax entity type. And sometimes it lacks one or the other, but if you just think of it as that each one has two legal entity types, it'll start to help you put this stuff in order in your mind. The legal entity type is set up for liability protection, ownership structuring, possibly anonymity. The tax entity type, that's set up to tell the IRS and the states how much money they get to take from you. So let's start with one of the most common entities that investors use, the LLC. What is an LLC? It's a limited liability company. And that is put in place to protect you legally and to protect you from the risk that happens inside of that business or that rental. When you have an LLC, if you set it up and maintain it properly, you've created a bubble. And everything that happens inside that bubble is subject to the risk of anything else in that bubble, but it can't get outside of it. So what does that mean? If someone goes to sue you in your rental or inside of your LLC, or if a creditor tries to come after you in your rental or your LLC, they can't get out of that. The lawsuit can't get out of that to get to your personal belongings, to get to your home, your car. They can't get to your other business holdings. So you set that LLC up to protect yourself legally from anything that happens inside the business in your rentals. Now, I'm here to tell you that if you're serious about creating a successful business or real estate portfolio, there's only one way to set up the LLC. Use an attorney. That's my 2 cents. There's other ways to do it without that, but if you want to make sure your operating agreement is ironclad, your partnership agreement is ironclad, that you've got all your I's dotted, your T's crossed, you need to shell out the money and use an attorney to get this set up correctly. Now let's talk about one of the biggest myths in the tax world. Go start an LLC and you can start to write off all of your tax deductions and move things to be tax deductible. Nothing could be further from the truth. An LLC changes nothing for you from a tax standpoint. It is a legal entity. If you have a business, regardless of whether you decide to set up an LLC or not, you can deduct any expenses that are ordinary and necessary. There is nothing additional that you can deduct just from setting up your LLC. From the IRS's standpoint, the LLC, once set up and nothing additional is done, is the same as you from a taxability standpoint. As far as the IRS is concerned, once you set up an LLC, it changes nothing from a taxability standpoint. It is still you. You are the business until you go make a tax election, which we'll get into later. That activity that happens within that LLC, it will flow and go onto your personal tax return, your personal 1040. If you own real estate, it's likely going on a Schedule E. If you have a business, it's likely going on a Schedule C. But to the IRS, it's you and it's going to be taxed the same. Now, if it's an active business in the real estate world, that might be flipping, wholesaling, property management, realtor work. That's going to end up flowing to your Schedule C until you make an additional tax election. Now, there are some additional legal tax structures that you can get into. Things like limited partnerships, limited liability partnerships, C corporations, and all of those may be beneficial to you from a legal standpoint. We're not going to get into them too deeply on this channel other than to touch on them when they come up, because this is a tax planning channel, not a legal entity channel. With that said, let's go through a breakdown of the most common legal entity setups. If you own the business by yourself, you're going to start it from day one. It doesn't have any legal structure. If someone sues that business, they sue you. So initially, as soon as you have any risk there, you're probably going to go set up an LLC. And at that point, you're legally protected as long as you set that up and maintained it properly. However, from a tax standpoint, it's no different. You can then tell the IRS how you want to be taxed, and that's when you need to get your accountant involved, and we'll get into that in another video. The only other possible legal entity structure that comes up for an individually owned company is a C corporation. Now, this is rare, and we probably won't get into it too much in this channel because they're not typically beneficial for real estate investing. Now, if you start a business with anyone else, by default from day one, you're a partnership. You need a separate tax return to be filed. That doesn't necessarily mean there's going to be any additional taxes owed, but you are now a partnership you still don't have any legal protection until you go set up a legal entity. So if they sue that partnership, they sue the partners. You can then be an LLC, a limited partnership, limited liability partnership, or a handful of other partnership type entities, or you could be a C corporation. So what about taxes? I thought this was a tax channel, right? You're not here to learn about legal entity setups. You're here to learn about how to save taxes. So let's come back to the LLC. Initially, you set up that LLC, and if you're an individual, it's called a disregarded entity. If you own rentals through it, it's gonna go on your Schedule E. If you have active business through it, it's gonna go on your Schedule C. Now, if you own the LLC with at least one other person, you have a partnership. You very likely need to file a separate partnership tax return called a Form 1065. When you file that return, it will report all the activities of the business, but it will very rarely pay taxes. What will happen is that net taxable income will flow out to each partner. Those partners will then put it on their own personal 1040 tax return, and they'll pay taxes based on their own individual tax rates. So now that you have the LLC in place, that's step one. From a tax standpoint, you're able to choose how you want to be taxed. It's called checking the box. If you do nothing, as we've mentioned, you own it by yourself, you're a sole proprietor, disregarded entity, nothing changes. You own it with someone else, it's a partnership, you have a new tax return, you get a K-1 with your income, but also from a tax standpoint, nothing changes. So depending on what the business is doing, you're possibly going to want to file a form to check the box and tell the IRS how you want to be taxed. So your options for filing this election and telling them how you want to be taxed are to say you want to be taxed as an S corporation or as a C corporation. Or if it's in your best interest to stay as a disregarded entity or a partnership, you may not need to file that form and tell the IRS anything. So to recap, every business has a potential legal and tax entity type. If you're a sole proprietor and you don't set anything up, you have no legal entity and no legal protection. And from a taxable standpoint, it will go on your personal tax return. If you're a sole owner and you set up an LLC, you're now protected legally. However, it will still go on your Schedule C or your Schedule E of your personal tax return. If you're a sole owner and you set up an LLC and then your accountant elects S Corp status and puts everything in place to make sure that you function as an S Corp, you are now an LLC taxed as an S corporation. And in the same light, you could tell them you want to be an LLC taxed as a C corporation. Now, if you start up a business with your neighbor Joe, from day one, you are going to be by default a partnership. You will have a requirement to file a separate partnership tax return. You will not have any legal protection from that day one. What will happen is it will flow through and it will be taxed on your personal tax returns. You can go in and you can set up an LLC, or you can set up some type of limited partnership. If you set up that LLC, you can then tell the IRS, I want to be an LLC taxed as an S corporation. I want to be an LLC taxed as a C corporation. And lastly, although rare for small businesses, with either an individual or a multi-owned company, you can be a full C corporation. So that's a wrap here, guys, on legal and tax entity structuring, but this flows directly into our next video on active and passive activities and how you can start to utilize this to put yourself in the best tax position possible. Be sure to subscribe and check out the next video.